The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone to the Rebel Capitalist Show that I have really looked forward to speaking with. He is someone that I've looked up to and learned from immensely in the past. His name is Bill Fleckenstein. Bill, welcome to the Rebel Capitalist Show.
Thanks for having me, George.
All right, so initially, I want to give you kudos, and I want to bring up an example of what it means to be a contrarian. And kind of going to go off topic here. I remember listening to you on the QTR podcast with our good friend Chris Irons, and this is just when we'll call it the cerveza sickness to be YouTube friendly came out. This was maybe March of 2020. It might even have been February of 2020. And I remember you were telling Chris that you actually hoped that you would get it right away.
Yeah.
The complete opposite of what you would think someone would say. And he's like, well, why? That sounds crazy. And you're like, because if the hospitals are going to fill up, I want to get it right now while there's still capacity. And I thought to myself, that is the way a true contrarian investor thinks. Boom.
Well, that's you just made me think of something that I wouldn't have normally said, but what that with that real life example, I mean, I didn't really want to get it, but if I was going to get it, I wanted to get it early.
Right.
But the contrarian, some people think that it's just a lifestyle choice, and what it really is it's a risk and reward management. Okay, look, if I think I'm going to get the virus, let me have it now because my reward or my chance of getting better is way higher than if I get it later. So it's the idea of being a contrarian is not that you want to take the abuse that usually comes with being a contrarian for some amount of time before your ideas start to actually work, assuming you get it right. But the risk reward profile that you get by being willing to be in a spot where others don't want to be often skews your risk reward profile, and I think that's the reason why people end up doing that. It's not that they want to take all the crap you got to take, it's because it makes your money management and risk management easier, although you do pay in terms of frustration time, I think.
Yeah, that's a great point. That kind of takes me off topic, but I think it's a path we should explore. I remember when I first got into investing, one of the first few books I read were the Market Wizards books.
Yeah, great book.
All those.
Yeah.
And I remember a lot of the guys, especially in the original book, came from a background of gambling, and more specifically blackjack.
Yeah.
And I thought that was really interesting, and it prompted me to go out and read Ed Thorpe's book, Beat the Dealer.
Yeah, that's a great book.
It is, and just really practice to get my mind in that mode of thinking. But do you think that's why so many of the OG guys and gals that were just so amazing at this game came from a background of gambling? Because it's training your mind to think in terms of risk reward instead of just trying to figure out which direction the price is going to go.
Yeah, I think that, and probably guys that are good at gambling, that can do it over time, like poker and maybe poker craps and blackjack, where you can actually get odds that are not unreasonably against you.
Yeah,
I think they have some innate ability to weigh and come up with probabilities, like in cards. When you're playing poker, I'm not a poker player, but I watch it because I appreciate the whole risk management of what they do. They know the probabilities of what their outs are and things like that. So you can weigh, okay, what are my probabilities? What do I have to put up? In investing, we are always having to make up our own probabilities. What are the chances that this causes that? And if that happens, what do I think the chances are that this goes from here to there? What do I think the chance of the price of gold goes up $100? And if it does, XYZ that's on its butt might go up 25%. So I think it has something to do with being able to, you're making up the probabilities in the first place, but you can't lie to yourself, because if you do, it doesn't work, right? So I think maybe that's why some of these guys that are really gifted traders that we see and that successful even at trading, as contrasted to investing, I think that's why they're also good at that discipline.
Yeah, one thing I've learned as well from speaking to so many people in the general public just through the comments of my videos and then having the opportunity to speak to pros like yourself, it seems that amateurs tend to think in terms of certainties and the pros think in terms of probabilities.
Yeah, good point.
Yeah. And so another thing that I learned from the Market Wizards books is that everyone always talked about edge. You've got to have an edge. What's your edge? You've got to have, which is basically a mathematical edge. So if you have the law of large numbers, that you're bound to come out ahead. It's just like being the house or the casino, is that you're going to lose some hands here and there or some pulls of the slot wheel, but over time you're going to win because you have that edge. So how important is that? And the reason I ask that is because in today's day and age, it seems like everyone has completely forgotten about why that's important. And they don't ask themselves, do I have an edge, or am I just following the herd? And does the herd really have an edge?
Well, that's a great point, a question. I think part of the way to think about that is looking at how the investment world has changed in the last, say, 40 years. When I first got in the business in 1980, people that were still professionals in it, whether they're brokers or money managers, even though it was a small industry, had managed to navigate the 70s, which was especially 73-4, which was a devastatingly tough period in the financial markets. And they became quite good at figuring out, how the market might respond 2 moves in advance. And I was struck as I learned how things work, how, kind of far in advance the market discounted things, and it really did. And of course, the old saying, the market is a discounting mechanism, is true. But I think Warren Buffett's version of that, in the short run, the market is a voting machine. In the long run, it's a weighing machine. I think what's changed in the last 40 years is there's much more of daily activity is on the voting machine side, not the weighing machine. And I think a huge component of that is what Mike Green figured out about how passive investing dominates. And then in the ZERP and NERP world we live in, where people have turned, derivatives into structured products, whether we're selling option premium or the VIX or all that stuff. So I think the market has changed in that it doesn't really seem to discount things very far down the road. It more like reacts to today's news. So it's become harder, I think, for guys that are clever at figuring out where things might go and being able to read the tape when it's getting in sync, because of the change in the market. I was struck. I was at a grants conference maybe in 2018, and Stan Druckenmiller said he couldn't read the tape anymore as well. I mean, I'm bastardizing what he actually said, but because what he would look for, and what I think lots of us used to do, is start to see when something acts differently than it should, it catch your attention. Then you would look for corroboration. That doesn't really happen so well anymore. The noise factor is so high that the managing money has gotten incredibly difficult, and it's all kind of gravitated more towards momentum and large cap stuff. But again, because of this distortion caused by passive investing, largely, I think. So the whole investment business is totally different than it used to be. And for the time being, it doesn't seem like there's much of you don't gain much by figuring out things a couple moves in advance, because all you do is get trampled while you're waiting.
Yeah.
I kind of got off on a tangent there, but sorry.
No, this is great. I think it was in your interview with Mike. I actually wanted to bring that up when you and Grant were talking to him. I think one of you said, well, it's almost like the dumb money has become the smart money, and the smart money has become the dumb money type thing. So in this type of environment, I mean, is it even possible to have an edge, or is the herd right that just you might as well just throw your money in a S&P index fund and just dollar cost average and close your eyes?
Yeah, well, I think you can, I used to ask myself that all the time. What's my edge? What's my edge? Especially when I was running my short fund.
Yeah.
And sometimes it can simply be, well, I'm willing to be patient, or I'm pretty good at risk management, and so I can do this or that. And but these days, I think it's much harder to have an edge. I think what what you almost have to do is, if you is try to figure out when your unpopular idea, assuming when we're talking about being contrarians, if your is starting to work. When I was running short money, I used to call, okay, I got a thesis. My thesis is this will happen and that'll happen, and then they'll realize that they've got double booking and the orders will come in and blah blah. I'd have a theory about what was going, and then when I would start to see it play out, I would get bigger. And I haven't done that so much on the long side, because the difference is, you can get yourself in a position for capital gains, which makes trading less interesting. But I think that's one of the things I think that you can do, or maybe you can have an edge if you say to yourself, okay, I've got these positions right now, they're not really working. I mean, because when things are working, what do you need to talk about, right? But when we're in new ideas or we're trying to go in a different direction, things oftentimes don't work, and you have to figure out, am I just early? Am I wrong? Why am I early? Why doesn't anyone else? And you're asking yourself all those questions. And so I think if you can find a way to start to see the corroboration, again, it's harder because it's harder to read the tape, as I just noted, what Stan said. But I think that's about the closest thing you can have to an edge, is to know that you understand how to beef up your positions when it seems like it's finally kind of coming your way.
Do you think that it would be easier to have an edge if you were willing to invest outside the United States? I mean, as an example, I was talking to Jim Rogers a couple nights ago, and we were talking about Turkey, and he said that was something that he had just put on his radar, and he was going to start researching it heavily because he was very, very interested because of all the chaos they've had there, kind of the blood in the streets, so to speak.
Yeah, again, it's this. I don't know that a willingness to look will help for sure. And Jim is particularly good at finding these bombed out situations, going in and buying some of the things that he likes, and then sitting and waiting. And he's been doing it long enough that he's always got a book. I'm assuming, I never asked him this exact question, but he's always got a book of seeds he planted a long time ago, and they're starting to work. Like when Grant and I interviewed him, he was talking about Chinese wine stocks, and shortly thereafter they got lit up, So I think, again, that's sort of the contrarian. He's looking at it because he thinks, okay, things are as bad as they can be, prices are as low as they're going to go, and if I get in there, as that all starts to change, it'll start to work. So let's say you did that, you'd have to go in there and say, okay, I'm going to put a certain amount on now, and if it looks like my idea that other people are recognizing this start to come join you, you can beef it up. One of the things that was something that took me a long time to learn, coming initially out of the sort of the value school, was you can't blindly average down. If you have a small position or a small concentration of something, you can average down up to a point, but at some point you got to stop, and you can only average up, because otherwise you can average yourself all the way down to a really bad place, right? And so I think when you're taking things like Jim does and they're getting really unpopular, then I think you have to keep the amount of that, each one of those you have in your portfolio, small enough that they can't crush you if you're extra early. You know what I mean?
Yeah, absolutely. That was one of the questions that I had written down that I wanted to ask you about, because I think it's something that most people completely ignore, and it might be the most important thing, and that's portfolio construction. And everyone likes to just try to figure out, okay, is the price of XYZ going up or down? Is the price of Tesla going up or down? Is the price of, fill in the blank? But they completely forget about, okay, how, if I buy this or if I short this, how does it interact with the other assets that I have in my portfolio, and how diversified am I? And what is my volatility risk here? Because if you want to reduce your volatility, well, then you can just reduce your position size in something that might be extremely volatile, i.e. Bitcoin. So how important is that? And maybe am I overdoing it? And what did you do to try to manage that portfolio construction well?
Well, I think it's a really good point. And when I was running my short fund, one of the things that I did, because I would a lot of times be all concentrated in one area. One of the things I did was I said, okay, look, by definition, like Warren Buffett, one of his expressions was, put all of your eggs in one basket and watch that one basket very carefully.
Yeah, right.
So on one hand, he's saying, well, you got to concentrate, and on the other hand, other people say, well, you got to be diversified. Well, you can do one or the other, a bit of both, but you can't use the same tactics with each strategy. So if you're quite diversified, you don't have to hover over your stocks quite as much. If you're all concentrated in one area, you have to be much more proactive about managing your risks, because you don't have any diversity. I mean, if you're wrong on your idea why you're ganged up on these things, either long or short, you're in big trouble. So what I did when I was running my short book is I kept my funds small. I never got much over about $175 million, because even with leverage, I could get out of all my, I had different rules. Like I didn't short stocks that were single digits. I didn't short, really broken, or the, what do they call it? The value trap. There were things I never did just because I thought I would wind up getting too much, taking on too much risk. And I wanted to be able, the reason I kept the fund small was because I wanted to be able to be out of everything in a couple of hours if I decided I was wrong. Right. There's nothing worse than knowing you're wrong and not being able to get out of your positions. That's like the worst feeling ever. So
what are your thoughts on what happened with GameStop?
I think that, it was a combination of events. It's a manifestation of the environment we're in, with the, again, combination of indexing and then the derivatives market, and then the public, for this moment in time, being keen on the market and, the online effect and all that. It was like the perfect storm showed up, and it hit in a way that caused that to happen. We got a preview of that last year when the Hertz went crazy, right? And of course, the mainstream media never is accurate about short selling. I mean, there's all kinds of short sellers. There are guys that are short in the capital structure. They're short the equity because they're long the bonds, right? They're basically workout artists. And there are people that are fundamental shorts, like I used to be. And then there's what Mark Hodes calls the smash and grab, right? Where they issue a big negative report with a lot of splash, and then they get big in front of it, and they take it off. So the latter kind of guys tend to give the whole community a bad name. I was always quite vocal about what I was short, because I thought I'd uncovered problems, and I was, alerting people. Obviously, if I was right, I got paid. But other people, like I remember I had one jihad against Gateway Computer. I don't know if you remember them. Well, they were cooking the books. Yeah. And I'd been after them. And then finally, Gretchen Morgensen wrote a big article in the New York Times, and ultimately the SEC got them. Well, anybody who listened to what I had to say saved themselves a lot of dough, right? So I've gotten off on a tangent, but so what I used to do is I regulated I had other rules too about when I would be short and what were the right conditions and when did I have to be extra careful and all that. But I think the important thing is for people to realize that you have to use different tactics. If you're investing or if you're speculating, if you're trying to go long term or you're trading, all these different things require different sorts of tactics. And I think a lot of people have learned the wrong lessons because of sort of the unprecedented mania we've had at different force levels, if you will, in the last 20 years. and people have been rewarded by sort of trampling all over the laws of financial physics, if you will. They've gotten away with it, so they've learned the wrong lessons, and at some point that's liable to be quite expensive, I think.
Yeah, and they've been trained that just pretty much everything works, just
Right.
like Portnoy.
Right.
You know, just throw a dart,
Right.
buy it, and sooner or later it'll go up. You know, one thing that Jim mentioned on the GameStop thing is the short interest. He said shame on Melvin Capital or whatever, because whenever
Right.
I would go in there, I would look at the short interest first thing, and you would try to, you'd know which one could blow up in your face, and you'd stay away from it. So did you
That's a
look at
really
that
good
as well?
point. Yeah. That's a really good point. So I would always, I told you certain things I didn't do. I would always check the short interest to see how crowded it was. And really it's the short interest vis-a-vis the float that you got to worry about, not just the overall short interest. And again, if the Fed is printing money, it's very difficult to make money on the short side. If stocks are hitting new highs individually and as a market, it's difficult to make money on the short side. If stocks don't respond to bad news, difficult to make money on the short side. I mean, you put those few things together and a few other simple rules, and you can at least keep yourself out of trouble. And those groups of rules would have kept you from trying to short much at all in the last decade or so. I mean, last winter I got short pretty aggressively. I've tried a couple of times when I could see what was going on in China and the market didn't care. So that was one of those times. The market structure today is such that it's crash prone. But to really get a prolonged bad market environment, I think you would need to get layoffs to get to the point where the 401k automatic, retirement date funds that are feeding the market, slow down or stop or go the other way. Or if the bubble gets big enough that even the amount of monetization that we're doing isn't enough. We've never seen that before. Every mania in history, or certainly every mania of the last 100, well, let's say since 29. You look at 29, you look at 69, you look at 87, you look at 89 in Tokyo, and not really 87 so much, but you look at 99 or 08, you had periods where there was this massive euphoria and people believed that financial gravity didn't work anymore and they didn't have to follow the rules, however you want to say it. But into those periods, the central bank had always been withdrawing some liquidity. Now, maybe they weren't doing it fast enough, and that's how they created the bubbles in different periods. But there was some level of that, and then the crowd would continue to be crazy, and the mania would exhaust itself at a time monetary conditions were unfavorable, and the thing would collapse. Now we've got an environment where they've told you we're not even going to think about taking away any of the stimulus until well after inflation has hit our target, which, oh, by the way, we only made up in the last 10 or 12 years. And so there's no telling how crazy things may have to get for the equity market to finally tip over.
But I think you've mentioned a few times that you're kind of end game, to use the title of your podcast, Grant, is that the bond market just won't play ball. And I know I talked to Peter Bookvar the other day. He said, well, the Fed can want inflation to run at whatever hot or whatever, but if the bond market says, no, we're not going to let inflation run hot, then inflation isn't going to run hot. Or maybe inflation gets to a point where it's like the 1970s, where the long end of the curve just can't keep pace, or something happens with yield curve control. But if we got to a point, because you were talking about how you look at a company and have a kind of a game plan. If this happens, if this happens, if this happens, if it follows your game plan, then you start to get more aggressive. So if we saw that playing out, where inflation did start to run hot, let's say, and the bond market started to not play ball, to where it backs the Fed into a corner, or the government, to where they can't come out with a $2 trillion stimulus package every other month, because inflation really takes off the bond market and that crushes the economy. Is that where, on a macro level, you start to get more aggressive, because it's kind of your game plan is playing out? More aggressive on the short side is what I mean.
Yeah, it's a really good question. So I kind of walked away from the short side in 09 when they started QE, and I haven't really been back. I've dabbled a few times, and because nothing on my checklist would really allow me to get aggressive. But my firm belief has been and continues to be, and one of the reasons we started the Endgame podcast was to talk to smart people that we could find who and talk about how this can end. My firm belief is, since all the central banks are doing the same thing, it's difficult to see the foreign exchange market ever really stop. I mean, how does the dollar and euro really differentiate themselves when both central banks are completely out of control? You know, I mean, we can get down to the minutia. We could argue the positives of the dollar versus the positives of the euro and all that. So I think that the bond market is going to stop the Fed at some point. My shorthand expression is the bond market will take away the printing press.
Right, right.
And people would say to me, well, how is that possible when they're buying all the bonds? Well, you've just seen the 10-year, you know, basically double, go from 75 basis points or so to 160-ish, 170. So now, I mean, the bond market isn't in full tantrum mode. Maybe it was just mispriced. It shouldn't have been at 70 basis points given what was coming. So now it's just backed up to where it probably it should be even higher probably in reality. But at some point, what I believe is going to happen is some fixed income guys are going to say, wait a minute. Like, we're coming up to a point between now and between, say, the data we get in, say, April and July, August. There's going to be a lot more inflationary pressure in the inflation data. And as bad as the indices are, like the CPI and the PCE, in actually reflecting actual inflation, it's going to start to percolate. Now, I don't think the data in the official statistics matter. What really matters is when the average investor or average person start to conclude that we might have an inflation problem for a prolonged period of time. That mentality hasn't really existed since the 80s, even though the last time we had a real problem was the 70s. And I think people have been trained that no matter what the Fed does, there won't be any inflation. No matter what.
How do they come to that conclusion, Bill, if it's not reflected in the CPI?
Because, well, that's the best way, actually. When people are going to the store or paying their bills and they see what's actually happening and the government's trying to tell them that it's only going up at 1.9% and they can see their own stuff's up 5 or 7 or 10, depending on, a lot depends on what your basket of goods you need. Right. So it's a class and a wealth thing. But I think people will not need to read the CPI or PPI or the PCE to decide inflation is going to run way higher than they expected for a long period of time. They're going to come to that conclusion based on their own lives. That's what I believe. And at some point, that will filter through to fixed income portfolio managers, and they'll say, you know, I'm not really getting compensated for going longer on my duration. I'm going to reel it in. Yeah, I'm going to get less. Well, if you've done that in the last year, you're a hero now, right? Your duration's, you know, under 5 years, let's say, and you know the bond market got routed, but you're okay. You're down where you gave up some yield, but you know I think the 30-year that was issued last summer, summer recently, I don't know what the coupon was, 1 and change. Well, the price of the bond now is 70. You know, so you can take a pretty big hit. And so I think the math of all that will start to matter, and guys, and maybe it'll show up first in the corporate market. Let's say credit spreads widen, not because of credit quality concerns, but let's say you're that fixed income portfolio manager, say, you know, I don't really want to buy XYZ Corp at only 80 over treasuries because the inflation rate's going to run that hot and something bad could happen to the company. At least with the government, I know I'm getting my money back. Maybe credit spreads widen. But anyway, some ways the bond market will start to price in higher levels of inflation. And I think when that finally happens, the stock market could have a hiccup. I don't know. But I think when that happens and the bond market ceases to or starts to reflect higher levels of inflation, that's when we might get some yield curve control. And if we get yield curve control at a moment in time where the market is not sure it believes in the willpower, not the tools, the willpower of the central bank, then it could kind of get interesting. And I think that's the moment in time you'll have to look to where, okay, could the markets actually break somehow? Mm-hmm. Once the Fed tries to say, no, you guys are worried about inflation and you shouldn't be, and here we're going to force you to believe this, with yield curve control. So that's my working hypothesis. Whether it plays out like that, I don't know, but that's kind of what I'm looking for.
We talked about how Mike Green has shaped your thinking in that interview that was just incredibly profound. That was one of the best interviews I've ever heard. But another one that's right up there is your interview with Grant and Lacey Hunt.
Yes.
And the reason I bring him up is because I don't know if he still is, but at the time of the interview, he is more in the deflationist camp.
Yes. Yes.
Or disinflation. I should say disinflation, not necessarily deflation. So, and obviously he's just completely brilliant. So, but you're more on the inflation camp. So how did that conversation get you thinking differently? And I don't really want to say it this way, but if you're still in the inflation camp, what do you think Dr. Hunt is getting wrong? And I hate to say he's wrong about it.
No, listen.
For him, but
when he and Van have probably put on one of the greatest trades in history. They've caught this bond bull market for 40 years, and they're still there, even though yields have fallen from at the peak 15% down here to a few percent, depending on what month you're looking at it. Lacey feels strongly that unless we get bank credit creation, you can't really get inflation.
Yeah, right.
And he's got a track record to prove that strategy works. And so I believe that psychology is a bigger component at flipping the switch, and that the preconditions are in place now for lots of price hikes, shortages, and the kind of things that can change psychology. One of the points, when we talked to Paul Singer, one of the points that he agreed with was that psychology is the whole ballgame. Mm-hmm. So it's a little chicken and egg. I would never say Lacey's wrong, because he's been dead right, and the way he's played has been dead right. We're going to find out, I think, in the next 3 to 6 months, how this next period is going to be, because we're going to get inflation data. We're going to get shortages. I get emails every day about these sorts of things. And I think a lot of smart people, I have a friend who's a bond manager, who's a very smart guy, and he believes in Lacey's thinking, but he shortened his duration because he thought all this was going to lead to what we've seen so far. And he's waiting to see how the data looks in the, call it, April to August period. Is this inflation rise that we're almost certain to get going to be just temporary? Just a flash in the pan? I think that's what the vast majority of people believe. Or is it going to stick for a while? And if it starts to stick, how does that change things? And so that he's set up to benefit, as he has, by the inflation scare, not the inflation, the real thing. He doesn't know whether it'll be the real thing, and nor do I. But the preconditions, I think, are in place, unlike they ever have been before. When you look at the monetization on top of monetization, and the fact the Fed cannot stop, they're actively championing 2% inflation, but they've told you, we're not going to guess that it will get here. We're going to react after it's been here. We're going to let it run hot. And oh, by the way, you've got Congress pushing all kinds of stimulus and wage increase types of ideas and misallocation of capital kinds of things. And then you've got all the shortages in spot. And people have learned that prices can go up and you can't get stuff. So that started to flip psychology. So when I put it all together, it's like, this is the greatest potential opportunity for more inflation, and not just a scare, but something real that we've had in 35, 40 years. Meanwhile, you can find assets that benefit by that are being given away. And by that, I mean gold mining companies. Right. The gold mining companies, I was the director of Pan American Silver for about, I don't know, how long was it? 15, 16 years. And it used to be that the mining companies never looked cheap. And they in the cycle before this one, they all made bad acquisitions and never really made any money, had to write a lot of stuff off, took a lot of debt. They all got religion. I could show you 5, 6, 7, 8 companies with great balance sheets, mines in great places, selling at less than 10 times earnings. Some of them pay dividends. Some of them have a very good growth profile. etc. So I say to myself, okay, look, this inflation scare is almost a slam dunk. What we don't know is what comes next. Is it going to be the real deal? I think the probabilities are high, but I don't know yet. Well, I believe I can capture that massive change with companies that are valued. There's a company called New Gold, and it was a basket case, and the guy came in and turned it around. At today's prices, it's selling about 6 times earnings.
Right.
And it's got upside. I mean, the valuations are late 70s, early 80s valuations. So if you want to own a couple of those, to say, okay, if the music starts to change, I got stuff that's got next to no downside and could really go up a lot. Now, the problem is when stocks get cheap, just like when they get expensive, the valuation doesn't mean much. So when something gets really dopey, you can't short it because it's expensive, because it's probably going to get more expensive. And perversely, when they get cheap, there's no level of cheapness that matters. Now, other companies come in and buy them out. But I mean, so again, you can't just say, well, they're cheap and I can just own, an unlimited amount, because it can go from, just because it's 6 times doesn't mean it can't go 5.5 times or 4 times. But the fact of the matter is, if somebody wanted to say, I'm going to protect myself from this, there's a whole group of securities you can buy where you're getting them, at insane valuations and cheap valuations, and the managements are all doing the right things. And in a lot of cases, there's inside buying. So I kind of got off on a tangent there, but that kind of puts the whole thing together. So we'll have a good idea, I think, by mid to late summer where we are in this process, and the world could look quite different prospectively, but we're going to have to get there to find out.
Yeah, those are so many great points there. It seems like the difference between the super smart guys that are in the deflation camp and the super smart guys that are in inflation camp, it doesn't really become an economic question. It's more of a political question, in the sense that, is the government going to continue to do stimulus? Well, it's not really an economic question. It's more politics. And I don't know that many Americans realize, and I went and looked at the data from the government. They've got a website, I think it's the Bureau of Economic Analysis.org,
Yep.
or something like that.
Yep.
And most people don't realize that incomes in the United States, Q1 to Q2 in 2020, went up by 30%. 30.
Is that because it's all the stimulus checks? Yeah.
Yeah. While unemployment's up at, let's say, 15, 20%. And even in January, when that last Trump stimulus went out, incomes went up by 10% in just 1 month. So you've got, by definition, you've got people higher unemployment, therefore fewer goods and services being created. Forget about all the supply chain disruption. You layer that on after the fact, and then you have incomes going up. And to your point, it's just how do you not have a short-term inflation shock? Now, is it temporary, permanent? Again, I think that's a political question. Do we get UBI? What happens? And then as far as the gold stuff, everyone talks about real interest rates. So, and do you think that's as big of a deal as most people say? If so, why? If not, why? And do you see that being the catalyst to change for those gold mining companies?
Well, historically, in periods where gold really ran, it ran while rates were rising. And a lot of it had to do with the psychology of the time. What do I mean? In October of 1979, one Saturday night, Paul Volcker jacked interest rates 200 basis points. Took them from, I think it was 9 to 11 or 7 to 9. I don't remember what the exact handle was. And he was trying to tell people that he was serious about breaking the back of inflation. Remember, he wanted to watch the monetary aggregates and said, we're going to curtail the growth in the money supply to break the back of inflation. The price of gold about tripled between October of 79 and January of 1980. Nobody believed him. He told you what he was going to do. He acted boldly, and nobody believed him. And then, in fact, in the 80s, they continued to not quite believe him anyway, but that's a different issue. So the psychology of what people think makes a big difference to the outcome. Now I got myself sidetracked. I forgot the question. Sorry, George.
Oh, no, I was just talking about real rates of
Oh,
interest.
yes. Sorry. Yes.
Catalyst.
Yeah, right. So anyway,
market.
real rates then were high and rising because he kept jacking rates, but gold ran anyway. And in other periods, gold has run despite interest rates going up. The problem with gold as an asset is it's very difficult to get a handle on what's going to move it today. Why is it moving? Why is it doing what it's doing? You know, if we're long retailers, you and I are long Nordstrom's, we can go to the stores, we can check the parking lots, we can do lots of things to try to figure out how business is doing better. We can do it with short stocks for short. But with a macro asset like gold, there's not a lot you can focus on. What's going to be the driving force? And what you find is sometimes dollar yen matters, sometimes dollar euro matters, sometimes the stock market matters. Now that the story is rising real rates, and if you look at TIPS charts and you invert them, you can see there's been quite a correlation.
Right. Yep.
The problem is that we don't have rising real rates. As the bond market has been backing up, we've had less negative real rates because, you know, so but no one ever says, okay, listen, we all agree rates are negative. What we don't know is by how much. Right. George, you think the rate of inflation is 3, but I think it's 5.
Right.
Now, my friend who's the bond whiz says the market doesn't care what you think; it only cares about what what the tips think. Well, maybe, and for now, that's the battle cry. You know, the tips market rules, and people talk about rising real rates whenever interest rates fall. Let me ask you this question: do you think people change their minds every single day about what the future level of inflation is going to be, and they recalibrate it? Of course. So it's kind of a sloppy, lazy indicator, even though it works. So it has been working as the bond market has backed up. You know, routinely, the precious metals have been backing off since August, and even though there's not any rising real rates. So it's one of those kind of things where you have to acknowledge that correlation is meaningful today, and it's meaningful until it isn't. But you also have to know that it's kind of an urban legend that it's the only thing that matters.
Right.
So you're kind of stuff saying, yeah, I don't really believe this, but the market does, so I've got to pay attention to it in terms of how I'm going to manage my risk.
And it sounds like it still goes back to psychology.
Yeah. I mean, that's
figure out what's going to be the catalyst to shifting that psychology from just, okay, prices don't really go up that much. They might go up here and there, but the average Joe and Jane doesn't really notice, to a point where we were in the 1970s. And, you know, that's one thing that I asked Jim, because I tried to get the vibe for what it was like back then. Did the average consumer, were they cognizant of prices going up to a greater degree than they are today? And Jim said, absolutely. Because back in the 70s, every time you went outside, you looked at the gas station, you could literally almost see prices going up. And he said something, although we might have higher inflation now than the CPI would lead you to believe, it's not to the degree that it was in the 70s.
Yeah, it's not anywhere near in the fabric of society. I mean, muscle memory amongst portfolio managers is that there's nothing that can really create inflation, you know? And a lot of people have not seen it. And it was in psychology. People thought there was nothing that could be done to stop the inexorable rise of price increases. Nowadays, it's almost
what's happening today.
Yeah, it's the flip side of it, exactly. So we'll have to see. Something will, if this is going to be a problem, something will have to come along and manifest itself that causes a change in thinking. And I think at the individual level, people are much more aware of this than they are, say, at the portfolio manager level, if you get the difference. I mean, and just when those two are going to connect, I really can't say, but some combination of that realization has got to happen for anything to change.
Bill, excuse me, I've got to look at my questions here because we've been talking for 45 minutes and I've gotten to 0 of my questions I wanted to have. But it's such a great conversation. All right, so when you wrote the book on the Fed, I wanted to ask you, what epiphanies did you have when you were doing your research? Did it change your thinking in anywhere, or did you discover things that you thought may have been partly true, but it reinforced those beliefs. And then, how does that shape how you see the Fed? And I'm trying to get at the damage the Fed does. Maybe it's intentional, maybe it's not, but the damage they do to the economy over time.
The reason why McGraw-Hill approached me to write the book, because of some of the writings that were kind of out there that I had. I wrote a column for MSN in addition to my regular column. I had already been chronicling all of that since Greenspan had been. I started writing my column in the spring of '96, and one of the reasons I started the short fund was I thought Greenspan was going to do a terrible job. He was already, being too aggressive in his monetary easing and all that stuff, and I thought it would end badly. I'd have a short fund to capitalize on how it ended, and then I'd go back to the long side. Well, it didn't play out that way. But when I was writing the book, most of what I wrote, I already knew.
Okay.
And so I didn't, the book just kind of poured out of me. Quite frankly, I wrote the book in about, the McGraw-Hill came to me because they wanted a book. They did, some director at McGraw-Hill wanted to have a book that was more factually accurate than the one Greenspan was going to write about himself that was due to be released in early '08. So they cast about and they found me and they talked to me in August, September of '07 and said, well, we need this by January. And I said, you're right. Anyway, I wrote it in about 90 days. I'd done all the work and I had some help from a friend named Fred Sheehan, and he'd done a bunch of work too. And so it was really it just kind of was pretty easy for me to write. And I didn't really learn anything new because all the things that I wrote, I'd already formulated those viewpoints.
Right.
So
is the main damage they do, and I'm trying to think just broad macro, is the main damage they do because they create money that is inflationary over time, and as opposed to maybe like a deflationary type of money we had in the late 1800s where nominal wages are going up per capita. You've got nominal GDP going up, but yet the cost of goods and services are going down. So the average Joe and Jane, their purchasing power is increasing every single year instead of decreasing and falling behind the rate of inflation. Or is it the boom bust cycle that they create by all of the money printing? Or is it that the economy becomes kind of a monetary heroin addict that needs more and more of the drug, which distorts the economy and creates more malinvestment and a misallocation of resources? Or is it a combination of everything?
Well, it's been an evolving process. We've ended up at the monetary heroin part. The problem with Greenspan, as opposed to his predecessor, and even maybe some of the other people who've been at the Fed, especially the successful chairman, they had an intuitive sense that too much cutting of rates or too much easy money would lead to bad things. It's like too much of anything usually leads to a negative consequence of some sort. And what used to happen when we were on some sort of a gold standard or a variant of that, or other countries that were tied to that sort of thing, was you wouldn't maximize growth necessarily, but you wouldn't create massive bubbles. Now, we did in the late 20s because Benjamin Strong and the Federal Reserve messed around with that. And what the mistakes tend to be, in my opinion, is they don't understand that CPI inflation is not the only bad inflation. If you inflate asset prices in a sort of misallocated capital sort of way, which is obviously subjective, you can have far bigger problems than you do with a rising CPI. And so that was my belief in the late 90s, was what Greenspan he didn't understand that the asset inflation was way worse. It was going to lead to a collapse. It did. They tried to bail it out with the same policies. We led to an even bigger bubble in real estate, financed by bad loans in the banking system, which the Fed itself was supposed to regulate as a part of the repeal of Glass-Steagall, and then that collapsed. And so each time they've had to go in bigger and bigger, and now we're at a point they can't leave NERP or ZERP They can't stop QE. They try to stop it. They're completely trapped. But people look at it like where we are is a good place, not recognizing that we don't have any policy. We have one policy. And so it's a complete monetary heroin type situation. We didn't start out there. We could have stopped and paid the piper along the way. We'd have been much better off, and we wouldn't be where we are today. Now we've got this complete disaster of epic deficits in monetization, which is what brings me always to talk about the end game, about the Japan, the question that you and I kind of talked about online, right? I mean, just to see, are these central banks basically just going to monetize this debt, and then in the end they'll get away with that? What will that look like, right? So that's why I've been so fixated on that idea.
Yeah, we went back and forth on Twitter there, and I'd love it if you could expand on your ideas, because I know you've given it so much thought on a debt jubilee with Japan. What really shaped my thinking, because I tried to think about that as well, and what really shaped my thinking is the interview you had with Dr. Lacey Hunt, where he was talking about the damage that is done when the government spends the money in the first place, because it misallocates resources and because it, the malinvestment and the distortions of the economy. And by the way, I don't know if he brought this up, or it might have been research I did for a whiteboard video, but back prior to the Fed, government spending was like 3-5% of GDP. Now, especially with 2020, it's gotten up, 55-60% of GDP. So, I mean, you think about how detrimental that is. But my point is, in one of my videos, I use the example of a heroin addict. In that, let's say you give this guy a credit card for $100,000, and he runs it up buying heroin to become a heroin addict in the first place. Well, if you gave him a debt jubilee, where now he's got a credit card that's got a $100,000 balance again, he can go out and buy another $100,000 worth of heroin. But is he any healthier, or is he going to get less healthy? And that's kind of the way I saw the Japan situation, is they became a heroin addict. They're already a heroin addict. So even if they got that debt jubilee, as far as society as a whole, they would just get economically worse and worse and worse. But I know you were trying to think of it in terms of what would happen to the bond market, what would happen to the yen, and what would happen to some of those other, asset classes.
Right, because I sometimes like to think, like, if you're trying to figure out some macro imponderable, I like to take it to a ridiculous extreme, one way or the other, and think about what the world would look like. So in Japan, the Bank of Japan has purchased roughly 50%, I think it might be even higher now, of all the outstanding Japanese government bonds. And so the question is, if they basically extinguish them, what would happen? And when I say extinguish, people can get confused. They say, well, their balance sheet, if they just, look, all they have to do is take all the bonds they own, trade them to the government of Japan for a 100-year piece of paper at 1 basis point. In other words, a worthless piece of paper. They still have the asset on their books, blah, blah, blah. So nothing changes away from that. Just the two entities agree, we're going to change the terms. So in the wake of that, what would happen to the stock market, the bond market, and the yen? I don't know the answer. I can see it. It occurs to me, Japanese stocks may rally. They may rally substantially because they say, wow, we got that debt off the books. And so now there's no danger of a debt collapse. It also seems to me that would take away the danger of the deflationary collapse as well, because you took that off the table. Japan is the original home of all these deflationary fears that people have. And of course, Japan's a little different from a societal standpoint than America. It's hard to compare because, we do have a lot of immigrants that come here and create businesses and help the vibrancy of our economy, and that's not true there. And their capitalism is quite a bit different than ours. Of course, we've bastardized ours pretty badly in the last couple of decades, but that's a different issue. But in any case, so then if you thought you knew what would happen in that extreme, then you'd have some roadmap for what would happen if look, I don't think the Fed's ever going to get these bonds off their balance sheet. They can't. So at some point, is that recognition going to be perceived as bullish or bearish, and for what assets? I don't know, but that was the genesis of, I mean, the Japanese pulled it off. They monetized half the debt. They got it out of the way. They own all these stocks and ETFs. I don't know what that's going to lead to. But the fact of the matter is, if you'd have said to somebody in the 80s, look, this government, XYZ government, is going to monetize the debts, people would say, you're out of your mind. They'll never let them get away with that. Well, today they can. Does that mean that people back then didn't understand things? Or does that mean that people now have a warped sense of what's right? I mean, I don't know the answer. I have my biases, but we'll have to see.
Yeah, what I always go back to try to stay grounded when I'm thinking through this stuff is, if that is true, if there is no negative consequence to what Japan is doing or what we might do here, I mean, we're following down the same path, then there is a free lunch.
Yes.
And it really comes down to that question. Do you believe it's possible to have a free lunch? Yes or no? And if it's no, then you've got to try to keep figuring out the end game, because there's got to be something. At some point you got to pay the fiddler.
You said it more succinctly than I did. I mean, that's the unwritten premise. Is there a free lunch or is there not?
Right.
And most of us that are involved in the markets know that the promises of socialism and communism never work because of human nature. We've all read Animal Farm, and we all know why it doesn't work. And we know, although there's a current generation of young people who don't seem to have gotten that memo in history class or the history of finance, but most people understand why it can't work. It's human nature. So in the same vein, the proverbial free lunch will just print up the money, and the money will still be worth what it was. And even though the new demands for constricted goods and services won't push them, there's no way that can work. It's not possible. But crazy ideas can work for longer time periods than people can tolerate. My favorite. So I mean, let's say they've gotten away with this for a decade, maybe 15 years of kind of the free lunch, and maybe it's about to end, and it went on for 10, 12, 15 years. You'd say, well, Jesus, that's a huge chunk of my life. Well, if you and I were standing around in the 20s, we watched what was going on in Russia, we'd say, this communism, this can't work. It'll never work. Well, it took 70 years before it didn't work. So you were right, but if you had been betting against it, it's a long time to be wrong before you were right. And so that's the part that I think we always have to keep in mind, is that, yes, 1 and 1 only makes 2, but people can decide it makes a different number for a long time. And you have to understand that and not be dogmatic about it. Must mean only 2 today, So that's the problem with these big, huge macro problems, is they go on longer than you think possible, and then they get crazier, and then it's much harder to be prepared when it finally is ready to end, because by the time it's when people have been convinced it can't possibly end.
Yeah. But then you and I wouldn't have anything fun to talk about.
Well, that's true.
All right, Bill, it's been an hour. I sure appreciate your time. So for my viewers and listeners who want to find out more about what you do in the podcast with Grant, which is fantastic, or buy the book. I think the book was Greenspan's Bubbles, or something to that effect.
His subtitle was The Age of Ignorance at the Federal Reserve.
Well, it's still a very appropriate title, that's for sure. Where can they go to check out what you're doing?
My Twitter handle is @FleckCap. And then I have a website called Fleckenstein Capital. I write a daily column and I answer questions, and it's $120 a year. So if people want to do that, I don't tend to promote it. I just been doing it for a long time, and a lot of people have found it valuable. So that's there too.
Awesome. Thank you so much for your time, and I can't wait to do it again.
My pleasure, George. It was really fun. It was a great conversation. Thank you.
Hi, guys. I'd like to invite each and every one of you to join me in Miami this June 11th through the 13th for Rebel Capitalist Live, the investment conference. And this is not over Zoom. This is face-to-face. I'm bringing a lot of your favorites from the Rebel Capitalist Show to Miami under one roof to speak, to give you the knowledge you need to increase your personal freedom, to become a better investor and make larger returns over the next few years when we have this financial uncertainty that's being caused by the Fed and the government. And finally, it's going to give you an opportunity to really take your understanding of macroeconomics and the world around us to the next level. We've got some incredible speakers lined up that are going to completely blow you away. People like Mike Maloney, Jason Hartman, Ken McElroy, Lynette Zhang, Mark Moss, Brent Johnson, Jeff Snider, just to name a few. The tickets for this event are really going to sell out fast, so make sure you go to Rebel Capitalist Live right now to get all the details and to reserve your spot. We need to come together as a group, as a community, especially after what we dealt with in 2020 and 2021, so we can learn how to build wealth and thrive in a world of out-of-control central banks and big governments. And we need to do this as a group, as a community of fellow rebel capitalists. So don't waste any time. Head over to rebelcapitalistlive.com, and I will see you in Miami.